The stock market has turned extremely bearish. So what's the best way to invest when prices are going down? I'm Biko Konstantinos, and that's what we're going to talk about today. Why don't you crack this video a like, and please consider subscribing to my channel. I'd love to have you on board so we can educate ourselves and stay on top of the markets. Now let's consider how we can invest in this bear market. Since COVID, we've had a wild ride in the markets. When COVID first hit here, there was massive panic in the stock market. Government stimulated the crap out of everything, and we saw a very sharp V-shaped recovery, which then turned to mass speculation and greed. Combine that with the unprecedented demand seen in the housing market, investors were in speculative heaven. But what happens if you keep blowing up a balloon? Eventually, it pops. And that's what I believe occurred right up here at the peak for the S&P 500. The stock market had run too far, too fast. It's like if you sprint a 200-meter race, there's just no way you can keep that same speed up after the 200 meters is finished. So how do we know we're in a bear market, or what we would call a downtrend? There's a couple of things that would tell us. Very simply, does it look like the market is rising or is it falling? With the S&P, when you have a series of higher highs and higher lows, that's what we would call an uptrend. But that all started to fall apart here, where the market didn't push on to a higher high and a higher low and keep going, but rather fell quite sharply, tried to rally a couple of times, and then fell to a lower low. So we're now definitely no longer in an uptrend, and it looks like a downtrend has really asserted itself. Moving averages help smooth out the price action, and here we can see that the 50-day moving average has crossed below the 200 and is falling quite sharply, and the 200-day moving average has flattened out and has just recently started to turn downwards. So the chart is really looking quite bearish, and a true bear market can actually last a long time, especially considering the speculative excess that we saw during the boom. For that reason, it's very important to consider your investment strategy during this bear market. I'm going to consider 3 broad type strategies. Strategy number 1, don't care about the bear. This strategy is all about the time in the actual stock market as opposed to trying to time the market. This is one of the most widely used strategies of nearly all stock market investors. What it involves is investing consistently into the stock market without caring about any of the volatility of the stock market or the direction. The reason this strategy works so well is that the stock market in general has very, very strong returns. And if you're consistently investing, your returns will smooth out and it will most likely mirror the performance of the market, especially if you're investing in the market index, for example, the S&P 500, or similar stocks that might mirror the market. This is a great strategy if you're consistent. Where it can be a bit more problematic is where you invest only in certain times, because what might happen then is that you invest at the top and then your stocks can potentially drop a long way and can take quite a while before you regain that peak. This can be especially true for people who don't regularly invest but get suckered in because of speculative hype, and I believe that's what's happened in the crypto market. When crypto was at its peak, there was mass saturation in the media and there was mass hype about the amazing returns. So people who hadn't invested suddenly threw money into crypto only to see it fall very large percentages. So as long as you're consistent and are investing regularly, say every month, then your returns will be smooth and they'll mirror the overall market. And that historically has produced excellent returns. Second strategy is I'm out. This strategy is not regularly used because it's very difficult to time the stock market, and pulling all of your money out risks missing some major moves, and there's also major tax implications of doing that as well. However, this is a strategy for people who don't want to see the balance of their portfolio decline in any significant way. There could be a variety of reasons why someone might want to do this, but probably the major one is that you believe the stock market is about to fall significantly, perhaps 20 or 30%, and you're not willing to see your portfolio decline that much. So for that reason, you sell up and put all that money into something extremely safe like cash or bonds. So that way, at least you know that you're not going to actually lose money. People employing this strategy would have a very risk-averse personality, and they might want to wait to see all the volatility leave the stock market before re-entering. This could be like taking out insurance or a peace of mind type strategy, especially if you're getting nervous and you think there could be some steep falls ahead. You might be willing to forego some returns for the peace of mind of not actually losing money. The third strategy I've called, this is what I live for. And this strategy is for people who love volatility, because in their mind, volatility means opportunity to profit. So one way you could employ this strategy is selling your stocks when you think we're near the top and then just waiting. And the scenario you're really waiting for is market capitulation or extreme fear and panic. This can happen when the stock market has fallen very significant amounts and extreme fear enters the market and people just sell everything they have because they can't stand to lose anymore. If this scenario does eventuate, it will mean that some amazing quality stocks are sold down to extremely cheap levels, and the opportunities for those people that are cashed up could be amazing. It's impossible to know when's the actual bottom of a bear market, but most bear markets actually take a while to conclude. And for that reason, there'd be plenty of time to spread out your purchases just in case prices fall more, and you can pick up even better bargains. An even more aggressive strategy for people who love the volatility would be to short the market. You can easily short using futures or products like contracts for difference. So just like in an uptrend where you would buy the dip and see it rally, in a downtrend, you could short sell the rallies and the price would fall after that. Now, shorting's not easy because in general, the market goes up a lot more than it goes down. However, in a genuine bear market, it can be an excellent strategy. If you were able to successfully make money shorting during a downtrend, you could then cash out and start actually buying quality stocks once you feel the downtrend has ended. So it can be the best of both worlds, but it's not easy. Another potential strategy for trying to profit in a bear market can be investing in safe haven type sectors. For example, precious metals like gold and silver can often do well as a safe haven because when everything else is going down, there can be a rush to assets of value. So investors might look to buy physical gold or silver. They might buy the actual gold or silver price, or they might buy gold or silver stocks, as in miners, hoping that those companies will become more profitable as the gold and silver prices rises, and then they can sell their product for more money. In the same regard, people might buy Bitcoin or other cryptocurrencies as a potential to profit if world economies go real bad, which could cause a massive rush to quality cryptocurrencies. So what should you do? Well, the answer could be different for everyone. Everyone has their own risk tolerance, their own investor personality that suits them, and also their own view or thoughts on the market in general. The main thing that I would recommend is just to think about it. Think now, what would happen if the market fell another 20% or even 30%? Because that is a possibility. And it's always best to have pre-thought all different possibilities. Sometimes a combination of strategies can work. For example, you have your long-term stock portfolio, which you just leave, but you could try using a small amount of funds to short the market, which could be used as an insurance policy if the market goes down. And if it does go down, it helps you to profit to be able to actually buy more stocks at a greater price. So I'm not telling anyone what they should do, but just to think about and consider what might be best for you. Yes, we're in a bear market, but I don't believe we've seen any real fear or panic at this stage. People who are invested in crypto will really know what this feels like. It's a terrible feeling seeing the money you've invested drop 50% or even more. You can really have that sick feeling inside, that deer in the headlights feeling where you just see all your profits disappear, or even worse, you start to lose large amounts of money. I've experienced that and it's a terrible feeling. And what normally happens is that pain can get so bad that you just give up and sell, and that normally happens just before things start turning around. And then you scream and swear at the market, but unfortunately, the market just doesn't care. If you have a certain strategy that you use in bear markets, I'd love to hear about it. Or if there's something you've done recently or plan to do, I'd love to hear about your different strategies. There's no perfect strategies, they all have different risks and rewards. I feel the S&P 500 could easily drop down to this pre-COVID level around 3,400. And what it does from there will be very significant in my opinion. It could potentially form a base over a period before reasserting a new uptrend, or the price could actually fall through this level, and that's where we could really see some fear and panic enter the market and some sharp sell-offs. One thing I don't expect to see is a sharp recovery all the way back up to this high. Obviously, it could happen because anything can happen, but personally, I feel there's too many headwinds in the global market to enable a very sharp recovery. I believe that a lot of this massive rise after COVID was due to government intervention, so because of those excesses, it could take a long time for them to be all unwound. When you consider that we're at the very early stages of interest rate hikes, strong company growth and profit is going to be much harder going forward. Right around this top levels, stock market valuations were extremely overpriced. Now they might be a bit better, but they probably still have to fall down to these pre-COVID levels to be more reasonable. So my personal view of this current market could be that we will continue to see a downtrend, which could slow and turn into a base formation, or we see the market grind lower, or a capitulation event where the price just shoots down and then potentially forms a base before the new uptrend can commence. Those are just my current views, and I'll be watching the price action closely, so if things change, then my views will probably change with them. So whatever happens, I wish you all the very best during this volatile period. I'm Biko Konstantinos, and I'll catch you in my next video.